Welcome to Keys Open Doors. Today, we're breaking down how to save thousands on your mortgage by understanding interest rates. Buying a home is literally one of the most exciting journeys you can take, but let's be honest for a second. The financial side of it can feel like a total maze. As a home buying educator, I see so many aspiring buyers focus purely on the purchase price of the home, completely missing the hidden costs of borrowing. But today, we're changing that. We're going to look at the math behind mortgages, translating all that confusing financial jargon into plain English so you can make empowered decisions. To help you take absolute control of your borrowing costs, we're going to look at 4 specific levers you can pull: your credit score, the down payment, the loan terms, the loan types, and then we'll wrap up with the final step: negotiation. Now, in general, to see how these levers actually work in the real world, we need a baseline. So throughout this explainer, we'll use a standard scenario, buying a $400,000 single-family home as your primary residence. By keeping that home price constant, you'll be able to see exactly how much power you have over the final cost just by tweaking how you finance it. All right, let's dive right into level 1, your credit score. The very first lever a lot of buyers can focus on is building a solid credit profile before they even think about applying for a loan. You know, your credit score is basically a trust rating for lenders. It tells them how much risk they're taking on by lending you money. Let's compare an applicant with a 625 score to one with a 700 score on a standard 30-year loan. Both of these buyers are purchasing the exact same $400,000 house, but lenders view them completely differently, and that translates directly into the interest rate they get. Look at the sheer scale of the numbers here. At the highest typical rate for that lower score of 625, you could pay over $671,000 in interest alone over 30 years. But look at the higher 700 score. That total drops to roughly $406,000. Let that sink in for a second. That means simply improving your credit score could save you up to $264,523 over the life of the loan. I mean, that is life-changing money. That's a college fund, a retirement nest egg, or just absolute financial peace of mind, all achieved just by focusing on your credit health before you buy. So the big takeaway here is this: applying with a higher score generally means lenders offer you much more affordable options. You get access to those lower interest rates because you represent way less risk. Plus, a stronger credit profile means you actually have more banks competing for your business, giving you the power to shop around for the best deal. Moving right along to level 2, the down payment. Your down payment is the cash you're bringing to the closing table right out of your own pocket. Now, while there are tons of low down payment programs out there, which are fantastic for getting your foot in the door, bringing more cash up front can totally change your financial trajectory. Let's see what happens when a buyer puts 10% down versus a much beefier 25%. This means we're comparing bringing $40,000 to the table versus $100,000. It's a massive jump in upfront cash, but let's see what it actually buys you over the long haul. This brilliantly illustrates the power of leverage. With a 10% down payment, your borrowing costs can shoot past $600,000 in interest. But by stepping up to a 25% down payment, your total interest plummets to roughly $330,000 over that same 30-year period. By adding $60,000 upfront to your down payment, you can save up to $272,017 over 30 years. Think of it like an investment. You're effectively getting a massive guaranteed return on that extra 60 grand you put down, purely because it prevents hundreds of thousands of dollars in interest from ever compounding. This massive saving happens for 2 compounding reasons. First, you're financing a smaller overall loan amount. The pie is literally smaller. But second, because you've got more of your own skin in the game, the lender's risk drops and they typically reward you with a lower interest rate on that smaller pie. Win-win, right? Next up, level 3, loan terms. Your loan term basically dictates how long that interest gets the chance to snowball. While many buyers naturally default to a standard 30-year fixed mortgage to get the lowest possible monthly payment, which totally makes sense, comparing it to a 15-year term is incredibly eye-opening for general education purposes. Check this out. While a 30-year term maximizes your interest at over $600,000 in our worst-case scenario, a 15-year term slashes it down to roughly $152,000. You're cutting the timeline in half, sure, but you're cutting the total interest paid by way more than half. Compressing your payment timeline into 15 years can save you an absolutely staggering $449,842. Now, yeah, your required monthly payment is going to be significantly higher, which means this option isn't the right fit for everyone's budget. But if you can comfortably afford it, the wealth building potential here is just immense. A shorter term generally means less risk for the lender, which once again gets you a lower interest rate. And even though those monthly payments are chunkier, it's vital to realize that much more of your money goes straight toward building your home equity right out of the gate, instead of just paying for the privilege of borrowing. That brings us to lever 4, loan types. The mortgage market is definitely not one size fits all. Let's contrast a standard conventional loan, which is what most people picture when they think of a mortgage, with government-backed options like VA or FHA loans. These have different qualifying rules and, crucially, different interest rate structures specifically designed to make homeownership more accessible depending on your unique situation. Compared to those high-end conventional interest costs that can top $600,000, qualifying for a VA or FHA loan can bring your total 30-year interest down to about $365,000. These programs are just built to be more forgiving and affordable for those who qualify. Using these specific loan programs can keep up to $236,553 right in your pocket over the life of the loan. It is absolutely crucial to research all the loan types you might be eligible for before you commit, because the product you choose dictates the rules for your entire loan. To break it down simply, if you're a U.S. military veteran, an active service member, or a surviving spouse, a VA loan is an incredible earned benefit that often requires zero down payment and offers highly competitive rates. On the flip side, FHA loans can be a total lifesaver for borrowers who might have lower credit scores or down payments under 10 to 15%. And finally, the final step, negotiation. All right, so once you've polished your credit, saved up that down payment, and picked your term and loan type, remember this. The very first offer you get isn't necessarily the best one. Closing costs, mortgage insurance, discount points, origination fees, they vary wildly from lender to lender. Always compare official loan estimates side by side. The interest rate is a huge piece of the puzzle, but it's not the whole shebang. And remember, always consult with licensed professionals to look at the total picture for your specific situation. So what do you think? Which of these 4 levers are you going to pull first to start taking control of your financial future? Keys Open Doors, helping you unlock your path to homeownership. If this helped, like, comment, and subscribe.